Well, good evening. Hi, I'm Mike Clouden, CEO of the Institute, and thank you very much for being here and coming here for this evening's forum. Our topic is, of course, Lord Adair Turner talking about his new book, Between Debt and the Devil, Money, Credit, and Fixing Global Finance. It's a small topic, so we'll probably have, finish up in 5 or 6 minutes and then have lots of time. Before we get started, a couple of small items. First, our next forum is going to be Tuesday, December 1st. Arthur Brooks, who's the president of the American Enterprise Institute, will be here to talk about his new book, The Conservative Heart, How to Build a Fairer, Happier, and More Prosperous America. And our last major event, large event of the year, will be our annual California Summit. That's Tuesday, December 8th at the Ritz-Carlton in Marina del Rey. The details are to be found on our website. That is an invitation-only event, but if you're interested, you can contact us and see if an invitation is available. And then just two other important things to say. First, Lord Turner has agreed to stay behind after we're through tonight to sign his books. Thanks to our friends at Barnes & Noble. They are available for sale there in the corner. And they're a great read, and I'm sure you're going to be interested in doing that after you hear our talk. And then after our discussion between our speakers, we'll be opening things up to questions. But as those of you who've been here recently know, we do questions electronically, not from the floor. So if you have a question, you can send it anytime in one of two ways, either via text or email. The information's right up there for that. We do that for really because it allows us to get far more questions in than we otherwise would be able to do that. But please understand that we cannot always get every question in. So if your question is not one of the ones asked, you can blame anyone but me because I won't be choosing it. So, but seriously, we hope we'll get them all in, but if we don't, we may run out of time. Our apologies if we don't. All right, we're fortunate to have as our interviewer tonight, Matt Miller. Matt's a Senior Vice President at Capital Strategy Research, where he analyzes U.S. policy trends that affect investment decisions. Most of you probably know him for at least two other things. As a longtime host of KCRW's popular weekly program, Left, Right, and Center, and as a candidate for Congress last year, for which I salute him for being willing to do that, and I commend you to his article, which is available online in Politico, isn't that right? About his experiences in doing that. And also, I should mention, Matt is the author of two other books, but we're not plugging them tonight. But they are available. And he's written for the Washington Post, Fortune, and been a White House fellow and a good friend of the Institute. So with that, I turn it over to Matt, and you're in for an enjoyable time.
Thanks, Mike, and it's great to be at the Milken Institute. Thanks to all of you for taking time out of your busy lives to have what I think will be a serious but also really lively and interesting conversation about the state of the global economy, really arcane seeming issues like the future of central banking and monetary policy, and what we need to do to move past the kind of malaise, as Adair Turner calls it, that we've kind of been stuck with since the big financial crisis of 2008, where so many people are still struggling, not just in the U.S., but even more in countries around the globe. The genesis of this event was I actually read the book when it was in galleys over the summer and got so excited about it that I really wanted to help Lord Turner bring it to a broader audience, and what better place than the Milken Institute to try and reach folks in thoughtful Santa Monica and the West Side for folks who are interested in these issues. What I really admire about what this book does, as you'll see, is Lord Turner, and I'll give you a little more of his background in a second for those of you who aren't fully familiar, but he is a mainstream senior policymaker, not just in the UK but globally, given the role he's played in recent years, who is really challenging the boundaries of debate in terms of where policy and where central banking and where regulation needs to go, because what we've done since 2008, and as he sketches through the book, and as you'll hear in the kind of conversation we do tonight, what we've done, while necessary, isn't sufficient if we're going to get back on track. And he's challenging the entire policy community, and then all of us who try and support leaders or encourage leaders to think more broadly, to just get outside the box and think about some things that might be seen as kind of radical for someone in the policy-making positions that Lord Turner has been in to actually be advocating, and that's what makes this subversive and sexy and interesting, even though it's about central banking and bank reform and the financial world. So that's a big thing to live up to, I know, but we'll do it. But just briefly, for those who don't know, Lord Turner became chairman of the Institute for New Economic Thinking, aptly named, a few months ago. And his new book is Between Debt and the Devil, Money, Credit, and Fixing Global Finance. Prior to that, he chaired the UK Financial Services Authority from 2008 until 2013, during which time he played a leading role in the redesign of the global banking and shadow banking regulation, is chairman of the International Financial Stability Board's Major Policy Committee. Prior to that, he's had a business career combined with public policy and academia. He was at McKinsey when he was younger. He was Director General of the Confederation of British Industry, something like our Chamber of Commerce, I think, something like that. Vice Chairman of Merrill Lynch Europe, Director of a number of companies, and he's been a lecturer and visiting professor everywhere that matters on the planet. So please welcome me in joining Adair Turner formally to our evening. So, and this is really going to be like the audible version of the book. So you still have to buy the book afterwards as an author. And it's very important, even if you feel like you've gotten what you need, it's nothing like actually reading the book. So take it from me. I read it when it was just a Word document, and that's what led me to kind of corral all of you to be here tonight. Why did you write this book?
That's a good question. I tried to describe that in the preface for the book. I actually became chairman of the UK Financial Services Authority on a very precise day, which was September the 20th, 2008, which was 5 days after Lehman Brothers had collapsed, 4 days after AIG had been rescued. Actually, there's a particular reason why I remember it so well. September the 20th was a Saturday. You don't often start a new job on a Saturday. But the reason why I did was the previous Monday, my predecessor, Callum McCarthy, rang me and he said, Adair, when does your contract say that you are starting when are you taking over from me? And I said, well, it says I'm starting on Monday the 22nd. And he said, well, I'd like that changed to next Saturday because I've just had a terrible weekend with Lehman's, and if things go wrong next weekend, I want it to be your weekend, not my weekend. So September the 20th I start. 17 days later, I'm sitting with our Chancellor of the Exchequer, our Treasury Secretary, Alistair Darling, and our Governor of the Central Bank, Mervyn King, and there's three of us on one side of the table, and we got the Chairman and Chief Executives of all our major banks on the other, and we're discussing the fact that we're going to have to essentially nationalise two of them, HBOS and Royal Bank of Scotland, put in money, guarantee loans, put in liquidity, etc. The system had collapsed. Autumn 2008, fundamentally dealing with the problems of firefighting, emergency reaction. And then, from early 2009, we turned to the issues of how do we re-regulate the banking system to make sure that it doesn't happen all over again. And as you said earlier, Matt, I was for 4.5 years very involved with the process of re-regulating the global banking system. I was chair of a committee which played a major role in designing what's called Basel III. You don't need to know what Basel III is if you don't want to know what Basel III is. It's a banking regulatory standard, lots of detail on bank capital, bank regulation. And I'm proud of what we did. I think we made a difference. I think because of the new regulations that we've put in, that the financial system itself is more stable than it was before and less likely to produce a sort of self-reinforcing crisis like that which developed in 07 and 08. But I increasingly became of the belief that although we were doing good work, we were still skimming the surface of why the crisis of 2008 had occurred, and in particular, failing to address the issue of why the recovery from the crisis had been so slow and difficult. And I think this is a very important point of just how disappointing the performance of all the advanced economies has been since 2009. I mean, here in the US, your performance has been the best of the major economies, but it's still the case that your income per capita on average is something like 15% below where it would have been on pre-crisis trends. In Europe, and real wages for many people are still below where they were before the crisis. In Europe, income per capita is still below where it was in 2007. Almost nobody in 2009 anticipated that the recovery would be so slow and slow and weak. Almost nobody anticipated that we'd have 7 years keeping interest rates at zero in order to try and stimulate the economy, but the economy still being disappointing. And as that developed, I became convinced that we had to go back to some more fundamentals to work out why 2008 occurred, and in particular, why recovery has been so difficult. And that's why I wrote the book.
And so take folks through you basically have an analysis of the credit-intensive model of growth that we've grown dependent on, and why that's ultimately not sustainable and gets us into these recurring cycles. Explain that for folks.
Well, the very first figure in the book is a chart which sets out the level of private debt to GDP. So this isn't public debt, this isn't treasury bonds, this is private debt to GDP, to national income, in all of the advanced economies together. And in 1950, that was 50%, and by 2007, that was 170%. And it grew pretty much every single year over those 57 years, and at an accelerating pace, and it grew pretty much in every single advanced economy. Now, what was interesting at the time is that if you were to go and ask the experts about this growth of private credit or debt, depending what you call it, most of them were completely unconcerned. There were people in the finance theorists end of universities who could give good explanations of why we definitely needed some debt, and indeed, insofar as they were worried about debt levels, their worry was all about places in the world where there wasn't enough debt. They'd say things like, Indian debt to GDP is only 10%, it needs to be more to provide credit to Indian businesses, etc. There was almost no theory which said, well, more debt than zero might be good, but there might be too much of it. Meanwhile, if you went down the other end of the academic corridor to where the macroeconomists sit, the people who write monetary theory, which informs what central banks like the Fed or the Bank of England do, they, broadly speaking, said this is of no interest to us whatsoever. To an extent which may really amaze you, the central bankers and monetary theorists of the world had developed the theory that the financial system was of no particular importance to the conduct of monetary policy. Interest rates just passed through the financial system. They said it was a veil through which it passed to the real economy, and they really didn't need to think about what the banks were up to, etc. So the overall point of view was that this growth of credit and leverage, 50% to 170%, was either positive or just neutral, but either way, it wasn't concerning. And what's interesting is that might have been a reasonable assumption if what we say in our economic textbooks, banks and capital markets do, if what they say they do, what we say it does, is what they really do. If you were to pick up undergraduate economics textbooks, I don't recommend that unless you suffer from amnesia, from inability to speak, to sleep. But if you do, you will find that it essentially says, what does a bank do? It'll say banks take money as deposits, and they usually assume these deposits come from households, and they lend money to businesses or entrepreneurs, and they thus allocate capital in the economy between alternative capital investment projects. And then there's lots of theories about how they do that, whether they do it well or not. Here's the problem, though. That's just a myth. the fundamental thing to understand about what banks do, and it's quite difficult to understand, but crucially important, banks don't just take money that already exists, they create credit, money, and purchasing power that didn't previously exist. The vast majority of money in a modern economy is not the dollar bills that you've got in your wallet, nor is it what's called the monetary base, which is reserves held at the Federal Reserve, which are liabilities of the central bank. They are the additional credit and money that has been created by the private banking system. And that fact is absolutely fundamental to understand how a modern monetary economy works. And it was something that fascinated a lot of economists in the early 20th century, including great American economists like Henry Simons and Irving Fisher, as well as fine Swedish economists like Knut Wicksell. They were fascinated by this process. And then from about 1960 or 70, modern economics stops talking about it and stopped paying attention. So banks create credit, money, and purchasing power. And unless we can constrain them, they can create infinite amounts of it. And secondly, banks don't primarily lend money to entrepreneurs and businesses to fund new capital investment. They used to 50 or 70 years ago, but as I showed clearly here, building on some very good work, including some that's been done, up further north in California at UC Davis by some researchers there. If you look at the banking systems of all the advanced economies, over the last 50 years, they have become fundamentally real estate lenders. They lend against real estate. And the amount of lending to businesses which are not in real estate is probably only about 15% of all the lending of all the capital markets and the banking systems in the advanced economies. And some of this real estate lending funds new commercial real estate or new residential real estate investment. But actually, the vast majority of what goes on in a modern credit creation process is that the banking and capital market system lends people to compete with one another for the ownership of assets that already exist, real estate assets that already exist. That's the majority of what modern banking systems do. And why this matters is that a lot of real estate, particularly in the cities where people want to live, is, as it were, locationally specific. It matters where it is, and a lot of the value of the real estate doesn't reside in the constructed bricks and mortar. It resides in the locationally specific land on which the housing sits. Now that's most obvious in central London or central Manhattan or central San Francisco or
Santa Monica.
Or Santa Monica. Yeah, I bet if we looked at the value of a house in Santa Monica, we'd find that it sells for something which will be a vast multiple of what it would cost you to actually construct that house. The reason why this matters, it means that when the banks extend credit for people to buy existing real estate and locationally specific real estate, you can't easily create more of it. You can't easily create more Santa Monicas or Kensingtons or Upper East Side or whatever. And so the only thing that gives is the price. And more credit gets extended, and then the price of real estate goes up. And then when the price of real estate goes up, both borrowers and lenders think, well, it'd be a good idea to borrow and lend some more money because the price of real estate goes up. And the thing goes round in a cycle which produces more credit and higher real estate prices. And it turns out that this cycle of credit and real estate prices is not just part of what produces crises in modern economies, it is again and again pretty much the whole of the story. It is the story of what went wrong with the Japanese economy in the 1980s. I don't know whether you remember the stories that came out of Japan in the 1980s. They had the biggest credit and real estate boom the world has ever seen. The amount of credit extended went up by about 4 times in 5 years. Commercial real estate prices went up by 2.5 times in 4 years, et cetera, et cetera. It was the time when there was a famous story that went around that if only you could buy and develop the land on which the imperial palace sat, it would be worth more than the whole of the state of California.
Right.
Now, that was probably an urban myth, but it captured a reality. it's what went wrong in Japan then, it's what went wrong in Massachusetts in the late 1980s, in Scandinavia in the 1990s, again and again, and it's what went wrong in this latest crisis. At the core of it is a credit and real estate boom in the US, in the UK, in Spain, in Ireland. It's what's going on in China at the moment. So we get these cycles of credit and real estate. There are other reasons why as well we end up with a high level of credit intensity. The other is rising inequality. As we have a more unequal society, and the tendency over the last 30 years has been quite dramatic here in the US and in most other advanced economies, we end up with a macroeconomic problem, which is that rich people don't spend as high a percentage of their income as poor people. In economist terms, they have a high marginal propensity to save and a low marginal propensity to consume. And that means that if we get more unequal, we will have a higher savings rate, which unless it is matched by more investment, and for a variety of reasons we may not need more investment, will produce what some people call secular stagnation, a lack of demand in the economy. But the way we solve that is that if you've also got a whole load of inequality, you've got a group of lower and middle income people who feel that they're not keeping up with better off people, so they feel that they want to borrow money to make up for the lack of dynamism of their real wages and their income. So a more unequal society tends to have a greater flow of credit as well. So there's both the real estate cycle going on and there's this unequal cycle. Both drive a process by which leverage tends to go up and up. And the way I'd sum it up in total is we've had economies for 20 or 30 years before the financial crisis where you can think of them as the following. Nominal GDP, nominal income in the economy, was growing at about 5% per annum. And the central bankers of the world sort of patted themselves on the back and said that's just fine, because that allows us to combine 2.5% inflation with 2.5% real growth rates. But all that time, private credit was growing at 10 or 15% per annum. It was continually faster than the growth of nominal GDP. And the problem with that is that it produces a level of leverage and eventually the system blows up. And it puts us into a situation where the situation post-2008, where the debt doesn't go away, it just shifts around the economy, and then we have a major problem.
So I want to get into that in a second, but what's so interesting, first what's interesting is that the gasp that we heard when people heard we've gone from 50% of GDP debt to 170%. It's just interesting that there's a visceral reaction to that. The other thing is that apart from you, and I think very few others, the idea of the focus on private credit decisions by banks, driven, I guess, by the animal spirits they're feeling at a particular time, is basically what drives all the money growth and credit growth that we see. And even until now, because you're trying to challenge the economics profession or the central banking kind of technocracy to look at this, it's been a weird matter of indifference to them.
Yep.
And doesn't that seem obviously wrong? If an audience of reasonably intelligent folks in Santa Monica say there's something out of whack if we're doing that, why would the quote-unquote professionals have convinced themselves somehow that this is a matter of indifference?
Well, it is a very good question.
And you take on the professional
and part of the book is about what went wrong with economics. In fact, the final chapter is called The Queen's Question, because Queen Elizabeth turned up at the London School of Economics about 6 months after the crisis, and she said, well, why didn't anybody see it coming? And they wrote her back a letter about 6 months later, the president, the head of economics, and they said, dear Ma'am, because when you write a letter to the Queen, you say, dear Ma'am. And she said, dear Ma'am, there was a collective failure of imagination on the part of a large number of apparently clever people. It is an extraordinary story because, as I said, macroeconomics developed a point of view that you really didn't have to pay attention to the details of the financial system of what banks were up to. And indeed, the way we taught undergraduate economics often had much less focus on the financial system than it had when I did undergraduate economics in the 1970s. Most universities back in the 1960s and 70s, as part of economics, would have required people to do a course on what was called banking and credit. How does the banking system work? How does credit work? A lot of those went out of the university curricula.
Which is an amazing...
It is an amazing thing. I mean, there are very complicated things in central banks use models. They're called dynamic, stochastic, general equilibrium models of the economy to help them think about how economies work. And these models have no banks in them. They have some companies, they have some households, they have no banks. There's a bit where there's a bit of the book which I entitled The Strange Amnesia of Modern Economics. Because if you went back to Irving Fisher, to Henry Simons, to John Maynard Keynes.
These are figures from the 20s and 30s, not all of which
figures from the 20s and 30s. Or if you went back to the early writing of Milton Friedman, there were a lot of banks in the writing. There was a lot about money. There was a lot about how money gets created. But it is really an odd thing. And why does it occur? I think partly it occurs because economics falls in love with mathematics, and it falls in love with precision. And in order to be able to run economics in a very mathematical fashion, it makes a set of assumptions which most ordinary people in their ordinary lives would consider just absurd. In particular, it assumes that human beings are entirely rational and that they are continually involved in viewing the future in an entirely rational fashion and developing probability distributions of future developments with which they inform their lives. Now, most of you, as you observe yourself and other people, do not assume that we are entirely rational. But that body of economic thought, which is developed in the 1970s on, which is based on what's called the rational expectation hypothesis, and alongside it there's a hypothesis of how financial markets work called the efficient market hypothesis, which says that share prices at any time are a completely rational assessment of all future probabilities. I mean, I can tell you, most of the richest speculators in the world don't believe in the efficient market hypothesis because they've ended up rich precisely because they understand that equity prices, do crazy things up and down. But somehow, and it is an odd story, economics ends up hypothesizing rationality, complex mathematics, taking the money and credit out of the system, and ends up with a set of propositions where essentially you cannot foresee the crisis coming because you've made a set of assumptions which assume it away. And that is the story, and it is a terrible story, I think, that in the run-up to the crisis, and I quote something from the IMF in the book, the IMF as the sort of custodian of a point of view of economics, well, actually, I'll read it to you. It's a nice little quote. Here's what the IMF says about the global financial system based on modern, good finance theory in April 2006. So this is only 15 months before we begin to get total disaster occurring. It says, and this is in the IMF Global Financial Stability Report. So this is a report you're meant to sort of read to think about the risks in the world and think about the way the world works. There is a growing recognition that the dispersal of credit risk by banks to a broader and more diverse group of investors has helped to make the banking and overall financial system more resilient. The improved resilience may be seen in fewer bank failures and more consistent credit provision. Consequently, the commercial banks may be less vulnerable today to credit or economic shocks. Now, this is written in 2006
by the high priests.
By the high priests of our economic system. I've always worried that the chap who actually wrote that is probably sort of chained to the dungeon in the IMF basement because they won't allow him out into the light of day any longer because it's too embarrassing. But there are a lot of embarrassing statements made by the economics profession and the central banks and the regulators of the world before, in 2006-2000, with this complete certainty that we had a more stable system, and that included not paying attention to the creation of money.
So we'll cycle back to that at the end a little bit, but I wanted to make sure people understood that, because one of the things we tell our 18-year-old daughter is she, embarks on life, is that you'll find in every walk of life the emperor has no clothes, and if you think there's something that's bull, it probably is. And the PhD economists, I mean, people observe this all the time. We've got some of the most powerful people in the world are the people in the central banks and the institutions that are PhD academics, and they can have tremendous blind spots that leave you, that leave us vulnerable. So let's, I just wanted to kind of underscore that, but let's go back. You were talking about the kind of diagnosis of the problem, the analysis, the credit intensity that's unsustainable, blah, blah, blah. We get to a point where these, there's boom, then there's bust, then there's dead overhang. Talk a little bit about that. So one problem is growth that's too credit intensive, 50% to 170% over a generation of GDP. But then when we have these busts, you're left with the Japans, all these areas. So kind of tie down the rest of the analysis, and then we'll talk about what to do.
So
people are still with all this, right? You look engaged, right?
In 2008, there's a crisis. The debt has built up. People have taken on board debt commitments they can't support. Prices have gone up and up and up. And then it's rather like that point, with a chap who runs over the edge of a cliff and then he looks down and he suddenly realizes there's nothing below. And, house prices collapse. And what happens then is that the fall of property prices makes people realize that they're over-leveraged. It makes investors realize that they're over-leveraged in commercial real estate. It makes householders realize that they're over-leveraged in relation to their own residential mortgages. And the reaction of people to that is what then drives the economy into a recession. In the US, what drove the recession in 2009 is not actually what is often said, that was that the banks were no longer able to lend money. It was that a whole load of American consumers, households, realized that they were over-leveraged and just hit the brakes in terms of consumption. And that has been beautifully illustrated in a fantastic piece of economic analysis by two economists, Atif Mian and Amir Sufi, in a great book called House of Debt, which came out 2 years ago. And what happened in America in 2009 was a repeat, slightly different, precise details, but a repeat of what had happened in Japan in the early 1990s. So we get in Japan in the 1980s this amazing, credit and real estate boom. In that case, it was primarily commercial real estate, offices, hotels, shopping malls, etc. But in Japan in the early 1990s, you get a whole load of companies and real estate investors who they feel over-leveraged, and in that case, they cut their investment. So somebody's over-leveraged. They either, if their household cuts consumption, they're an investor or a corporate, they cut investment. That drives the economy into a recession. But the trouble is, if you've got too much leverage, we then end up in an environment where the leverage doesn't go away. It simply shifts around the economy, and where all of our policy levers appear blocked or imperfect. What do I mean by it shifts around the economy? It shifts around in the following way. When the economy goes into a recession, tax revenues go down, public expenditures on unemployment benefits go up, and fiscal deficits rise. And those fiscal deficits, to begin with, are very useful because the increased borrowing and spending of the government offsets the fact that a whole load of households and businesses are trying to deleverage to pay down their debt. And indeed, in 2009, at the G20 meeting in London, there was an agreement of all the countries together. We've got to run large fiscal deficits because we've got to offset the deflationary effect of all this private deleveraging. But the inevitable consequence of that is that debt doesn't go away. It just shifts to the public sector. And after a while, you start worrying about rising public debt. So here's the figures for Japan. Between 1990 and 2015, Japanese corporate debt falls from 140% of GDP to 100% of GDP. But Japanese public debt goes up from 50% of GDP to 250% of GDP. And the total amount of debt goes up. And as I show in here from using some figures from a very good report called the Geneva Report, and also something produced by my former colleagues at McKinsey last year, that pattern which we saw in Japan, the private sector slowly deleverages, but it's more than offset by the rise in public debt. That is the pattern which has just been repeated in every single major advanced economy since 2008 or 9. And again, you know, our failure to learn, we'd had 17 years of the Japanese experience. That was the canary in the mine that we should have been paying attention to, and we didn't. But if you look, and you'll see it in here, the figures for Spain, for Ireland, for UK, the US, they're exactly the same. The beginning of some deleveraging of the private sector, offset by a more than offsetting increase in the public sector. And of course, after a while, we then start worrying about the increase in public debt, and we say, oh, well, we better start having fiscal austerity, fiscal consolidation, tax rises, public expenditure cuts. But then you've got the public sector trying to deleverage at the same time as the private sector, and then you'll drive the economy into recession. But then the central banks come along and they say, okay, now we can fix this. We can fix this with ultra-loose monetary policy. We'll drive the interest rate down to zero, the zero lower bound, as the central bankers tell it. And if that's not enough, at the short end of the yield curve, we'll drive the long end of the yield curve down with quantitative easing, and that'll get the economy going again. The only trouble with that is the transmission mechanism, if it's called, of this ultra-loose monetary policy through to the real economy is pretty indirect and is a bit unclear. Because once you've got interest rates down to 0.5%, and long-term interest rates, long-term US 10-year yield on T-bonds is about 2.2%. Once it's down at 2.2%, if by a whole load of quantitative easing you get it down to 2.1%, well, how many businesses are suddenly going to say, oh, whoa, the interest rate's 2.1%, not 2.2%, better rush out and do a whole load of investments? They're just not that elastic. This is what the Japanese discovered in the 1990s. You get to the stage, particularly if everybody feels they've got too much debt to start with, where they're very inelastic to further reductions in the interest rate. As is sometimes said, I think it's a phrase from John Maynard Keynes, in these environments, monetary policy is pushing on a string. It's quite difficult to push on a string. You do something and nothing much happens at the other end. So does QE work? Well, it's meant to work in some other indirect mechanisms. It's meant to push up the value of bonds and equities, and then everybody will feel a bit richer and they'll go out and spend.
And QE, so people understand, just make sure, QE is the central bank says it's going to buy.
Yep.
I wouldn't assume everybody.
No, okay, yeah. Well, I mean, the Federal Reserve has bought what, about 2 trillion or so, 3 trillion of US government bonds. That's the quantitative easing operations, which have gone over several levels, and the Bank of England's done the same, the ECB's done the same, the Bank of Japan has done the same. So we say it'll work through these increases in asset prices and everybody will feel richer, but the biggest beneficiaries of that are people who are rich already. And remember, people who are rich already, when they get still richer, don't tend to spend the money. So yes, it probably stimulates the economy, but it's a pretty indirect way of stimulating the economy. So we end up in an environment where we say we're out of ammunition. We can't increase the fiscal deficits more because of high fiscal debt, and monetary policy isn't very effective. And that's why there's a lot of talk goes on around these days of, are we stuck in secular stagnation? Have we got a problem of slow growth which we simply can't get out of? Is inflation going to stay forever at about 0%, which makes it difficult to get out of the debt traps we're in? That is the problem that we're stuck in, but I think there is an answer.
And so now let's talk about what you think the direction is we need to go. And I think you kind of divide it into kind of two categories. One is what to do with the kind of debt overhang that we've got.
Yep.
And the other is what? Just how to resume, how to kickstart growth at a time when the traditional policies seem like they've run their course.
Well, what I deal with in part 4 and 5 of the book is two policy questions. The first is, what should we have been doing in 1980 and 1990 in order to never get into this mess in the first place. And then part 5 is, well, what do we do now we're in this mess? Part 4 talks about the need to address the fundamental drivers of a credit-intensive economy, which are to do with the real estate cycle, they're to do with rising inequality, they're to do with global imbalances. If Germany, as it does at the moment, is running a current account surplus equal to 8.5% of GDP, which, just think about that, for every £100 of $100 of German national income, Germans are only spending 91.5. The rest they're piling up on claims of the rest of the world. Unless those claims take the form of actually buying some Santa Monica property or some equities on Wall Street, they're bound to be matched somewhere else by somebody borrowing money. That's just mathematics. So we've got a problem of rising inequality, we've got a problem of the real estate cycle, we've got a problem of global imbalances between surplus and deficits nations. We have to address those to have a less credit-intensive economy. And I also argue for far more radical regulation of the banking system than I was able to agree in all the debates I had with all my international colleagues over my 4 years involved in that process. So we can talk more.
Put some numbers on the banking thing, just on the capital level.
Okay, put that right. While I was involved in the debates about the Basel III capital ratio, the nature of the debate would be, and it's quite an interesting sort of oddity of the alphabet, this. We sit on the big oval table with about 80 of us around the table in Basel by alphabet. And that means
this
that
is in Basel, Switzerland?
In Basel, Switzerland, where we used to meet. And that means that the Swiss, the UK, and the US, you think about it, are all together at one end of the table. And the Japanese, the French, and the Germans are quite close to each other at the other end of the table. And it just so happened that in our debates, the UK, the US, and the Swiss were the hawks. We wanted, to get the capital standards up. And the French, the Germans, and the Japanese were saying, oh, we've got to be cautious. We need lending to the real economy. So I was an ally, for instance, with Dan Tarullo, who's, vice chairman of the Fed. I was closely involved in all of those issues. But the nature of the debate was, the hawks, down at the hawkish end of the table, were saying, no, we've got to get these capital ratios up for our major banks from 5 to 6 or 7%, and other people saying, no, be cautious. And so we managed to get, a set of tiers of capital, which in total take the biggest banks up towards 10%. And by the way, that's 10% of what's called risk-weighted assets. It's only about 5% of all the assets on an unweighted basis.
And that means for every dollar, for folks who don't follow bank capital, for every dollar of loans, you've got a dime of...
You've got a dime of capital.
Of equity investors who put something, or something like that.
Oh, and before the crisis, that could be not just a dime, it could be 2 cents.
Right.
Or 1 cent. Now,
people follow how leveraged
again, I think there's
banking
been
is.
another gasp. I mean, if you told...
This is an anti-leverage crowd.
If you told the ordinary person, it can be worse for prime mortgages. I mean, here's how bad it can be for prime mortgages before the crisis. Capital had to be at the absolute minimum. Equity capital had to be only 2% of risk-weighted assets, and you could say that a prime mortgage only needed a risk weight of 10. At the absolute limit, you could put a mortgage on your books which was funded 99.8% by debt and 0.2% by equity. Now, again, the ordinary person, when that is explained to them, might think that it is mad. And the ordinary person would be absolutely right.
And it's because if there's a slight drop in value of the asset,
then you've wiped out the equity.
Goes bust.
The bank goes bust. Anyway, we tried to get this up from 5 to 6. We were arguing. If I were the benevolent dictator of an economy being designed anew, and I didn't have to worry about transitions from where we are at the moment, I was just trying to get it right first time, I'd have a bank leverage ratio of about 5 to 1. Not 20 to 1. I'd have about 20% equity against the loans. So that's how radical I suggest
Which
that
is
should be.
double, basically, or more than double.
More than double.
Dust is cleared.
More than double, even where we got to after the significant increases. So that's a set of things that you have to do in order to stop us doing it again. And then if we return to how do we get out of this
And by the
mess?
way, banking systems used to run with more capital.
Oh,
right?
absolutely. Oh, yeah, far more.
And is it a irrelevant fact that bank CEO and executive pay is related to return on equity, and so the lower the sliver of equity, the higher in the good times the pay may become?
No, it's not irrelevant. It's got some relationship to it. No, look, bankers, like everybody else, they're trying to increase their own position, but because they can create credit and money, and because they're doing something which is potentially very risky, if we leave them unconstrained to pursue their self-interest, we will produce a much worse effect than if we leave restaurateurs to pursue their own interest. I mean, restaurateurs are not saints. They're still trying to make money, but fundamentally an entirely free market approach to the provision of restaurants works, because everybody in this room is well placed to decide whether they like restaurant A, not restaurant B. The market discipline works. There's a fundamental problem in banking that the market discipline processes don't work. We have to tightly regulate this process. It's a different category. And by the way, some of the most free market economists of the 20th century believe that. Henry Simons, who was a 1930s economist, he was a founding father of Chicago economics, which is, the most free market school of economics probably in the world. He believed that we'd made a real error in applying to banks the same free market principles, which in relation to all other sectors of the economy, he was an absolute supporter of. So that's something about how we don't get into the mess in the first
and
place.
just a footnote on that, because Milton Friedman's another one, right?
Yep,
whose
absolutely.
name will be more familiar to this group, was someone who we know is the kind of champion of free markets and of this era. But those guys, Simons, Friedman, writing in the wake of their own era's epic banking meltdown, said we can't treat banking the same way. And what I find particularly fun about the fact that that's true is it lets you inject, at least in the American context, the idea that you can cite folks like Friedman and the Chicago School for the kind of reforms that ordinarily in the U.S. debate would be, would make the conservative side's heads explode. Is fascinating and kind of delicious.
So Henry Simons.
This is like a poetry reading.
Henry Simons. Private initiative has been allowed too much freedom to determine the character of our financial system, right? This is the founding father of Chicago economics.
It's fascinating.
Anyway, so that's some things about should we move on to how we get out of where we are?
Totally.
Because this is also equally radical. We're not out of ammunition, right? There are some problems in economics which are really very tricky and intractable. But if our problem is a deficiency of what's called aggregate nominal demand, if we don't have enough spending going on in the world economy, and if we're in an environment where if there was more spending, some of that would end up in more employment and higher real incomes rather than just inflation. If that is our problem, there is always something that we can do. And that is something which is quite radical, but the person who most clearly explained what it was Milton Friedman. Milton Friedman says, if you're in a situation where nothing else works and you really are trapped and you can't get the economy expanding, you do what he called helicopter money. You fill a helicopter up with dollar bills and you scatter them on the ground and people pick them up and spend them. Now, that's not what you'd actually do. What you'd do is what I call overt money finance of fiscal deficits, right? You say, I'm going to run a slightly bigger fiscal deficit, either by cutting taxes or by increasing expenditure, and that's for the government to decide, and I'm going to finance it not by issuing interest-bearing debt, because then that raises the question, well, how am I going to repay that debt in the future, but by creating central bank money. And the crucial thing to understand is central banks are very powerful institutions. They can create as much money as they want. That is what a central bank is. Now, this is a very controversial thing to say, and this is why there's a phrase in my title which is the devil, and why up in the top right-hand corner there is a picture of the devil. And the devil here is an illustration from a famous work of German literature, which is Faust, Fast 2, by Johann Wolfgang von Goethe. And the reason why I referred to it is Jens Weidmann, the president of the Bundesbank, in autumn 2012, gave a lecture in which he came quite close to suggesting that Mario Draghi, the president of the European Central Bank, was growing horns and was about to do devilish things. But Jens said, look, we've got to be very, very worried about this quantitative easing because it will produce hyperinflation. And he referred to Goethe's Faust Part 2, because what happens in Goethe's Faust Part 2 is Mephistopheles the devil says to the emperor, Emperor, you don't need to be constrained in your expenditures by how much you can tax or how much you can borrow, because you can print as much money as you want. And of course, that means that saying we can print money is dangerous, because if we tell politicians they can print as much money as they want, they may go and create excessive amounts. And that's why whenever you start talking about helicopter money or overt money finance, people say, oh my God, it's going to produce hyperinflation like Weimar Germany or Brazil in the 1980s or Zimbabwe today. But it needn't, because the point about overt money finance is that in technical terms, it will undoubtedly work and will stimulate the economy. It is undoubtedly technically possible, and we can choose how much we do. If we did in the US economy 10 million of it, you wouldn't even see the difference because that's small. If you did 10 billion, it'd have a small effect. If you do 100 billion, you'd see a significant effect. If you did 10 trillion, you'd have hyperinflation, right? The impact of it on nominal demand depends how much you do. And the fundamental issue about overt money finance, about saying that under some circumstances we can ask the central bank to create money which the government spends, is not a technical issue. There's no doubt at all that it's technically possible and that you can control it. It's a political issue. It's an issue of, can we accept that it's possible in small amounts without opening up the danger that politicians will say, oh, you never told me that, now I'm going to do it in crazy amounts. Now, I think we can. I think we can by giving to the central banks, the Federal Reserve, the Bank of England, the authority to say, okay, government, you can do this amount and no more, and to have that authority in pursuit of an inflation target. So the Federal Reserve has been trying to get US inflation back up to 2. It's been trying to use quantitative easing. It's still short of that target. I'm saying it should have the authority to say, we authorize 100 billion, but no more of overt money finance. I think it's possible, but some people say, Adair, you're absolutely right in technical terms, but it's just too dangerous. And maybe that's right. Maybe it is just too dangerous because the risk. And what we've done with helicopter money, with overt money finance, is, although Milton Friedman talked about it, although Ben Bernanke talked about it, Ben Bernanke recommended it for Japan in 2003. He said, you're stuck in a debt overhang so deep that you should think about doing a tax cut financed permanently with central bank money. Again, this is not a crazy sort of, socialist inflation lover. This is a rather serious, grown-up, central banker. So it's technically possible. Some people say it's technically possible, but we should still never do it. And we've created around it a taboo. It's just something you're not meant to talk about. It's as if we treat it as a medicine which we know, taken in the appropriate circumstances and in small quantities, would help us, but we know that taken in large quantities it will kill us, and so we've banned it entirely because we're terrified that we don't know, we can't trust ourselves to use it in small amounts. But my argument is, we can, I believe, create a set of rules and institutional responsibilities that gives us the confidence we can use it in small amounts, and B, we're probably in such a deep economic malaise, certainly in the Eurozone, much more than in the US, but we might fall into it in the US, but certainly in the Eurozone in Japan, where without that tool, I don't think we're going to get out of it. And I'm really worried in the Eurozone, where continued slow growth in a continent of high unemployment, large migration flows, imperfectly integrated ethnic and religious minorities. If we don't get the Eurozone economy growing, we are playing with social and political fire. And the tools that we're trying to use at the moment of things like quantitative easing are just not doing it. And that's why I've said we should at least be willing to debate this issue, take it out of the taboo box, and consider whether there are certain circumstances in which we should use this undoubtedly technically available tool.
That's a great overview of the whole shebang, but I'm telling you, unless you engage with it and buy the book and read it in its full detail, you'll be missing something, so please do that. We're going to go to questions now, and let's see how they're doing. So the first is, Lord Turner, which countries do you think do the best job of financial regulation and why?
Well, I mean, obviously the UK. Okay. Okay, let me say a thing about who does the best. You know, that's a very trite answer. We made a terrible mistake before the crisis in the UK because we really took our eye off the ball of the total financial system. We were quite an extreme version of a regulatory approach that said the role of the central bank is to hit low and stable inflation, and that's it. There was one objective, low and stable inflation, one tool, varying the interest rate. And they were very effective at getting there, and everybody said, we've got a great system. And then separately, we had the regulator, which I ended up chairing after 2008, which regulated all of the different financial institutions, and that was a good thing to do because it meant that people couldn't escape our focus. But we did it in a very legalistic fashion, and we focused on things like insider trading and market abuse and, you know, bad behavior and ripping off customers. But we weren't looking at the way that the total system was building up risks. What we've done in the UK, and it is, I think, a good thing to do in the UK, is we've now created within the Bank of England, alongside the Monetary Policy Committee, which is our equivalent of the US FOMC, we have created a thing called the Financial Policy Committee, which is charged with continually looking at the totality of what the financial system is doing, whether it is insurance companies or asset managers or banks, and what's happening to the total level of leverage and are risks building up in the system. So I think that is a good thing that we've done. If I then look at the US system also had major problems before the crisis, and I think you've taken small steps towards fixing them, but not enough. One of the problems you had before the crisis was you had an incredibly fragmented regulatory system. You had the Fed had some responsibilities, state insurance regulators had some responsibilities, the SEC, the CFTC, the OCC, the FDIC, and you even had a wonderful thing called the Office of Thrift Supervision. And the Office of Thrift Supervision had been designed to deal with what it sounds like, you know, relatively small thrifts in the middle of rural Kansas or something like that. And you had a large institution called AIG Capital Markets, which had gone on a sort of fishing expedition to find out what was the regulator who would pay least attention to what they were doing. And they managed to get themselves regulated by the Office of Thrift Supervision, which was absolutely bizarre, given that they were running an enormous great derivative book and capital market stuff. You've abolished the Office of Thrift Supervision, but you haven't got rid of all the other duplications. And Paul Volcker, who's a friend of mine and I think a great thinker about it, still says there's huge unfinished business in the US about you've still got a danger that you could have activities falling between the cracks. So I'm afraid I'm going to avoid the question of who's best, but those are some of the things you have to think about in the design of regulatory systems.
So a next question has to do with what the reaction has been to the book. How are leading central bankers disputing your point of view, or how is the kind of central bank community engaging? I mean, it's been out, only been out about a month.
Yeah, it's only been out.
Great reviews in the New Yorker, the Economist, the Financial Times, and elsewhere. But what's been the reaction among the kind of the central bank elite?
Well, you know, I know them. Several of them are my friends. They're still my friends. And I think, you know, some of them are thinking about it. I think it's difficult because the fact that you must not monetize public debt has become an article of faith for central bankers, and an article of faith for a good reason. That the problem we faced back in the 1960s and 70s, as we, under the impact of the Vietnam War, the public expenditures, powerful trade unions, governments acting irresponsibly, we were worried about inflation. And at that time, we said one of the ways that you guard against inflation is to have one very powerful rule, which is that the one thing that central banks must never do is fund government deficits. And that became even more important in emerging markets, where you used to have just overt funding of public deficits, and that was what produced 1,000% inflation, 3,000% inflation. The governments would run a 10% deficit, and they just say to the central bank, where's the money for that? And so a lot of central bankers in the emerging markets are very proud of the fact that they at last have a constitution of their central bank which says, thou shalt not finance government deficits. So it's a bit concerning when somebody comes along and says, well, maybe we should under some circumstances. So it's become such a deep sort of article of faith for central bankers that it's difficult for them to take it on board. I think what some of them say, or not necessarily central bankers, or let's say senior policymakers, and to defend their position, I won't mention names, what some of them say, Adair, God, don't scare the horses. We're sort of doing this, but we'll do it indirectly. US government's running a large fiscal deficit. Federal Reserve is buying a whole load of debt. We say we're going to exit and sell it back, but God, we all know we probably won't. And post facto, it'll turn out it's monetization. But why do you have to tell everybody that it is? Because if it is, the Tea Party will be on us, down us like a ton of bricks, and they'll stop us doing what we're doing in any case. So there is an element, it's not crazy, which is a sort of a pragmatic thing that says we do the functional equivalent of it. I mean, let me give you an example in Europe. Europe is now doing quantitative easing. The ECB is buying every month large amounts of government bonds. One of the things that it does is it buys the bonds of a thing called the European Investment Bank, which lends money to governments and other things to do infrastructure investment projects. Now, once you put together that sort of path of things, it is financing infrastructure projects. So, it's getting through to the real economy. I tell you what I think is going to happen. I think these ideas are going to be taken more seriously over the next 5 years, because I don't think the existing policies are going to get out of this mess. One thing I think is going to happen in Japan, I think whether you like it or not, in Japan, this has effectively occurred, and we are going to recognize it. Japan now has a level of debt which cannot and will never be repaid in the normal sense of the word repay. If you believe that the Japanese government is going to switch from running a large fiscal deficit to running a large surplus and is going to pay down the debt, you're just not looking at the mathematics of Japanese debt. It's not going to occur, right? That debt is either going to be perpetually rolled over, or effectively it's going to be monetized by the Bank of Japan buying the whole lot and buying it permanently. And I think as it becomes apparent over the next 2 or 3 years that monetization has effectively happened in Japan, that will stimulate a debate which says, well, hang on, if it's going to happen, wouldn't it be best for it to happen within the framework of a well thought out theory of how much we want to do, how we discipline how much we want to do, whether it wouldn't be better to do it in advance rather than, once we've already built up a whole load of debt. So I think the argument is now being engaged.
David Chung of Investors Business Daily, who's here, asks, to slow down real estate bubbles, why not have rules that limit banks' proportion of loans toward that asset class? Has that been tried before? Is it hard to enforce?
In the book, I talk about things that would lean against the balance, the tendency of banks to head towards real estate lending. Seen from a point of view of a bank, real estate lending is the easy thing to do. And, this is not their fault. They gravitate to what's profitable for them to do. When you're lending against real estate, it feels like the credit analysis can be reduced to, well, what's the valuation of the real estate? And as long as I only lend 60% against it, I'm going to be fine whatever happens to the price. Lending money to a medium-sized business which isn't real estate backed, that's hard work. You've got to work out whether this entrepreneur knows what they're doing. You've got to look at their track record. You've got to look at the cash flows. You've got to look at whether there's a whole load of other people competing in that business and whether the project's going to work. So there is certainly an argument for leaning against it. We used to lean against it in many environments. You go back 40 years ago, and some banking systems really didn't let the banks go into residential real estate lending. In Canada, up until the 1970s or so, the banks were largely kept out of real estate lending, which was done by the equivalent of thrifts, of S&Ls, which, however, were restricted at the pace they could grow because they weren't allowed wholesale finance. They could only grow as fast as their retail deposits, etc. But broadly, and other countries had, we had similar limitations in the UK, so did the Japanese till 1980s. And then what happened in the deregulation waves of 1970s, 80s, and 90s, we said, no, that's all old-fashioned. All financial institutions ought to be able to do everything, right? We shouldn't have, some people who do real estate lending and some people who don't do. So we got rid of it. We could go back to that, or we could do things like increase the capital weights for real estate lending. If you lend as a bank across the world, because we have a fairly standardized system, to a non-real estate small and medium enterprise, the capital risk weight that you'll probably end up applying is about 100%. You'll have to add capital at 10% or so against 100% of the value of that. If you're lending against a prime mortgage, a mortgage with a loan to value of only 60%, the bankers' models could give you a thing that says you only need 10%. So at the moment, that loan to the SME, right, which is, by the way, just go back to the beginning, that's what our economic textbooks say banks are doing, lending money to entrepreneurs to fund business investment. That has a capital weight 10 times as much as a prime mortgage, and probably 3 times as much as even a rather subprime mortgage. We have had a system where we say the risk weight should be worked out by the banks themselves on their assessment of the risk to them. I argue that there is a risk of excessive real estate lending, which it is never rational for the banks to take into account, but is a big risk for society. So I think one of the things we should do is set minimum risk weights for real estate higher than the bankers' risk models would suggest. And I would, for instance, say that all mortgages ought to have a risk rate of, say, 50%, even if the model says that they're really safe. So that's another thing that you could do. What you can also do is have loan-to-value limits or loan-to-income limits, limits to the maximum amount of loan that you can provide as a percentage of the value of the house or as a percent of someone's income. The UK Financial Policy Committee now has the power to impose such limits if it thinks that the credit and asset cycle is getting out of hand.
That's great. And the argument, it's like pollution, right? It's like an externality.
It's like an externality, yep.
Next question. To what extent do you blame or attribute tightening regulations for the banking sector to a slow recovery from the financial crisis? Has there been sufficient reduction in systemic risk to warrant the much slower growth rate that may have resulted from it?
Okay, the first bit, to what extent do you blame or attribute? Is it blame or attribute?
I think it's, are you blaming
tight regulations
for
a slow recovery?
Slow recovery.
Okay, on the whole not. On the whole not. So the argument here is, it's a sort of, okay, I know that we got into a mess with light capital and liquidity requirements, but oh my God, it's 2009, and if you suddenly tighten the capital and liquidity requirements, you're going to restrict a new supply of credit just as the economy is knocked down. We spent a lot of time round the table in Basel and elsewhere debating that. And we spent a lot of time debating, okay, we know we've got to have higher capital standards to have a safer system, but we know that if we impose it now, that might slow the recovery. We spent a lot of time debating, well, does that say we should do it quickly to get it over and done with quickly, or slowly so that the banks can slowly migrate towards it? It is an important issue, and it was quite right for us to debate around it. It turned out the best resolution for it was actually what happened in the US, which was the stress tests of 2009, where they said to the banks, you've got to hit higher capital standards, you've got 6 months to do it. You can do it privately if you can go out and raise more equity to get to those higher capital standards in 6 months. If you can't do it, we're going to do a public equity subscription in you, whether you like it or not. Because when you do it that quickly, you maximize the likelihood that what happens is new equity going into the banking system rather than the banks restricting how much lending they do. So there are good ways and bad ways to do this, but on the whole, I attribute very little of the slow recovery to the tightening of the regulations and the things to do with the supply of credit. And again, I return to that book I mentioned, Atif Mian and Amir Susi's House of Debt. I think they provide a very, very compelling argument that the fundamental reasons for the slow recovery, for the recession and the slow recovery, were over-leveraged companies and households and a low demand for credit from borrowers, not a low supply of credit from banks. And certainly in the UK, in things like what's called our credit conditions survey, which is something the Bank of England produces, I think all our evidence suggested that the problem was on the demand for credit side, not the supply of credit side.
Let's have the next question up. And I'll try and make them go a little quicker. I think we've still got about 10 questions. I want to make sure we get as much as we can in. How will the Fed unwind its $4.5 trillion balance sheet? And if you were Janet Yellen, what would you do right now? And assuming the Fed starts tightening, how much will it help?
How will the Fed unwind its $4.5 trillion balance sheet? Dirty little secret, it may never. Right. It may never. I think it probably will, at least some of it, but it won't unwind all of it. I mean, let me give you an example. And if it doesn't unwind it, some of it effectively post facto becomes a form of monetary finance. So think about what happens in the US in the Second World War and afterwards. In a very fine book, Milton Friedman and Anna Schwartz, Monetary History of the USA, produced in 1960, they suggest that the US war effort was paid partly by taxes, part by bonds which were issued and people bought, and about 15% by monetary finance. And how did this monetary finance occur? Well, it occurred because from 1942 onwards, under what was called the Fed Treasury Accord, the Fed agreed that however many bonds the government issued, the Fed would buy enough to make sure that the interest rate never went above 2%. And as a result, the Fed balance sheet increased very significantly from 1942 to 51, right? In 51, it was decided to end that process and to return to normal peacetime processes in which that didn't occur. The Fed balance sheet never shrinks, right? It declines thereafter as a percentage of US GDP, but it doesn't shrink. That increase in the monetary base was permanent. And that's why Friedman and Schwartz said that was effectively monetary finance. It produced a somewhat higher rate of inflation than would otherwise have occurred. It also produced the extraordinary leap forward in the American economy. I mean, the 1940s, the wartime period, is the period where the American economy suddenly becomes the super economy of the world. So it's not a bad result. I mean, monetary finance then didn't exactly produce a catastrophe. Now, the scale of the increase of the Fed balance sheet which has occurred is way beyond what you would want to do if you were doing permanent monetary finance. I mean, there is no way I would have said that what you should have done back in 2009, 2010 is have 4.5 trillion of monetary finance. I'd be suggesting more like a tenth of that, more like 400 billion. That's what you'd be doing if you were doing a permanent increase in the fiscal deficit. So a significant amount will eventually unwind. And I just wouldn't worry about that. You know, the Fed will keep that balance sheet at that level as long as it is having difficulty reaching its inflation target. And as and when it has hit its inflation target on the way up and is worried about too much inflation, it will sell some of those bonds as a way of constraining inflation. And it's as simple as that. There's no necessity for it to unwind by some particular date. Whether it all winds or not, and when it unwinds, will be contingent on what is required to meet its inflation target.
And just briefly, when Janet Yellen raises, what would
Well, Janet
happen?
Yellen raises. My best guess now, given the October payroll figures, the latest figures on inflation, I think we now are at the point where at last there will be a minor increase, probably a quarter increase in Fed funds in December. I think thereafter the increase will be very, very slow. If I had to guess, I would guess that by 2018, US interest rates will be no higher than 2%. UK interest rates will be no higher than 1.5%. Eurozone interest rates will be 0 or negative. Chinese interest rate, lending rate, which is now about 4.25%, will be lower. It'll be maybe 2%. The Japanese interest rate will be 0 or lower. And my point is, if anybody had told you that in 2009, they'd have thought you were completely mad. But that just shows we're a long way from out of it. So yes, I think we're now going to see, and probably should see, the beginnings of an uptick in the US, but it's going to be very, very shallow because we are still, across the world, stuck in a very low growth and deflationary environment.
Say one word. This is my question, not one that's been teed up, but these ultra low interest rates for so long have really hurt savers, and people who are on fixed incomes or people who ordinarily would have depended on having some, what seemed previously reasonable interest rates to maintain the kind of income targets they had in retirement, let's say. What's the right way to think about that? It doesn't get much attention.
No, I think that's right. I think that the difficulty with ultra loose monetary policy is that it has increased inequality in two ways. It has a different impact on different categories of savers, people who have assets. If you have assets like bonds or equities, where the lower the interest rate, the higher the capital value, you have done quite well out of quantitative easing because you have had a capital gain. I mean, okay, if you now buy a T-bond, you get a lower yield, but if you had T-bonds to start with, the value of those yields are going up. If, however, your savings are in bank deposits with a variable interest rate, then when the interest rate goes down, the bank deposit capital value is still, $10,000 or whatever, and you're getting a lower interest rate on it. Now, it's an empirical fact that the sort of people who own marketable securities, bonds, and equities tend to be the better off, and the sort of people who have what savings they have in simple bank deposits tend to be middle and lower income people. And so the impact of attempting to stimulate the economy through quantitative easing and keeping lower interest rates has undoubtedly had an adverse impact in increasing inequality, which, given that increasing inequality is one of the reasons which has driven the credit intensity, which has got us into the mess, is a slightly paradoxical result.
And it's just interesting because, and I want to keep pushing forward, but I always sense that central bankers are very squeamish about thinking that any actions they have would involve explicit redistribution of income, but tacitly, one way or another, they're involved in that all the time.
Yep.
All right, now we go to the aesthetic question. Is greed a necessary evil to maintain a functional and efficient capitalist economy?
Self-interest is. I mean, greed, is there a divide between self-interest and greed? It actually gets to an interesting religious question. Is there a difference between wanting more money for yourself and the love of money? I mean, what the Bible actually says is not that there's something wrong in wanting money. It says that to love money is the root of all evil. And there's a subtle difference there between getting to the point where you love money as an end in itself rather than an end to have a nice lifestyle. And I think that's part of that distinction. But the crucial thing I would say on this is capitalism depends on people pursuing their self-interest. People are driven by the incentive to, make money, and they set up a restaurant chain, they set up a hotel chain, they set up a car company, they et cetera, et cetera. But, and this is a point that Raghuram Rajan made very well in his book, Fault Lines, which I think was one of the great books to come out immediately after the crisis. He says, in most areas of the economy, that desire to maximize your own self-interest exists within a balancing set of constraints. And those constraints are that if you run a restaurant, yes, you want to make yourself richer, but you also have some physical pride in the product, or you deal directly with customers and you want them, to do well. You want them to respect you. And in most areas of business, there is a physical product or a service. There isn't just a financial point of view. There's other things going on, and there is a direct contact with other human beings. One of the great dangers of finance, and Raghu sums it up in a chapter called When Money is the Measure of All Things, is that if your job is to sit in front of a screen each day trading, you are not subject to some of those other constraints that place the pursuit of self-interest within constraints. Because you're not seeing this person to whom, the credit which has been packaged into a subprime mortgage credit CDO. I mean, right out there's somebody who's borrowed some money, but you're not seeing them. There's something about the very detachment from the physical reality of the real economy and other human beings, which makes it easier for otherwise good people to end up doing bad things in financial markets. When you do a computer game, there is no morality. In a computer game, you're allowed to kill the other guy in a way which isn't considered, normal behavior in sort of everyday life. But sitting in front of a screen trading is rather like a computer game. And so it's quite easy for people to fall into the belief that the ethics of the computer game should be what apply. And I think that has a lot to how we ended up with the LIBOR scandal, the Forex scandal, all these trading scandals. They come out of an environment where you are so detached from the physical reality of the economy that you just feel you're in an environment where, self-interest is the only thing that matters.
Next question. Given the unsustainable growth of private credit in the last several decades, isn't it clear that we have a significantly distorted view of the level of consumption and quality of life that we can really afford? Because the growth of credit can't continue forever, is it unreasonable to expect economic growth in the future?
I don't entirely agree with this. I mean, I said that before the crisis we had growth of nominal credit of 5% per annum, nominal GDP income of 5% per annum, and credit was growing at 15% per annum. And it felt at the time like we needed the credit growth in order to have the nominal GDP growth. But I argue that we don't need that credit growth to have nominal GDP growth. That if we could fix the increase in inequality, some things to do with the way that the housing markets work, global imbalances, if we could have better capital regulations of banks, there is no inherent reason why a capitalist economy can't grow in equilibrium so that it grows at 5% nominal per annum with 5% on average nominal credit growth, so that you don't get this rise in leverage. And the issue of, did we have more consumption than we can really afford? I mean, ultimately, the pace of growth of consumption, which is affordable, is determined by the productive capacity of the economy. I mean, if we have, a system which is producing all these cars and producing all these televisions and producing all these mobile phones, then the consumption of all those cars and washing machines and mobile phones is something that we're capable of delivering. So the issue is something affordable is ultimately, the only reason why you could say that an economy is living beyond its means is if it's borrowing money from another economy, right? And yes, the US economy was doing that before the crisis, and the UK economy is doing that now. But at all the advanced economies together, that wasn't occurring. I think if we're really living beyond, so I tend to think of living beyond our means as being, about physical constraints, and the area where I think we're living beyond our means is the environmental pressures that we are placing on the biosphere, the atmosphere. That's where I worry about that we are degrading the real capital that we hand on to the next generation, rather than the issues of that growth was credit dependent. So insofar as credit is within an economy, I think it's wrong to say that the growth of credit suggests that, as it were, the standard of living was unaffordable. I think it creates all sorts of other problems. But if a country is only building up credit within itself, then I think you can't say it's living beyond its means in total. Yep.
We're heading toward the lightning round. We'll try and do quick questions and answers. Here's another from David Chung, I think, who was here. When do you predict the Fed funds rate in the U.S. will return to 4 to 5%? And with the global wash in money and debt, is that even possible?
I think it's going to be a long, long time, if ever. And you can see this in the latest Federal Reserve minutes. There's a discussion about what is the equilibrium real interest rate, and there's a suggestion that in the modern economy, equilibrium real interest rates might be 0, and therefore equilibrium nominal rates, what you would expect over the long term, is 2%. I think we may be living in an environment where we're just not going to see a return to those 4 to 5% levels.
Next quick question, though somewhat long. It seems like most economic models are predicated on population growth. Do economists believe that leverage can be a temporary substitute to deal with demographic issues? Do you see any alternative economic models for countries that have declining population growth, which is a number of them now? We're heading that way.
Well, I actually don't think there's a fundamental reason why countries with declining populations can't continue to have increasing income per capita. I mean, clearly, straightforwardly, if you have a declining population, you will have a lower rate of aggregate growth, but I'm not sure any of us really, get kicks out of, whether the growth of the economy is 2 or 2.5%. What we want is income levels to go up, and what that matters there is per capita. There are some problems that come from declining population growth, but I think, on the whole, I think the best pattern is to have, stable populations and neither growing nor declining.
Do we have another? How does the credit creation process differ between countries with well-developed capital markets, like the US and the UK, versus those with bank lending models, for example, Europe, Asia, not counting Singapore and Hong Kong?
Not all that different, actually. So the US has a large role for capital markets in its credit provision. People sometimes sum that up as saying, if you look at US credit, it is 70% provided by the capital markets, 30% by banks, and in Europe it's the other way around. That difference is almost entirely explained by the role of residential mortgage credit and the fact that that goes through the capital markets in the US and it doesn't in Europe. And it does that in the US because of Fannie Mae and Freddie Mac. That didn't occur because of a free market. It occurred because of a very dominant role for the government-sponsored enterprises, which came out of a particular set of the way that the political process and the housing market developed in the US. And the net, result of that, in terms of how much credit there is to the real economy, is not fundamentally different. You still end up with the vast majority of credit is extended against real estate, and that is done in the UK and in Germany by banks lending mortgages, and over here it takes the form of the creation of capital market securities, of securitized credit. but the impact in terms of how much leverage they're on in the real economy, I think, is less than people suggest. And actually, people end up with some mythologies here. They say, oh, Europe needs capital markets to provide, better credit to SMEs. The one thing capital markets never provide is credit to SMEs. Capital markets provide credit to large corporates through single name bonds and through residential mortgages through packaged securities. The thing which provides credit to SMEs is always the banking sector, because it's the thing that only the banking sector could do, because you actually need people who are relationship managers and who actually look customers in the face.
This may be our last question. How does the abolition of Glass-Steagall add to the cyclical banking crisis, if you think it does? Because I've heard folks on on the Democratic left, it's a common thing to say we need to reinstate Glass-Steagall. You hear other folks say that Glass-Steagall would not have prevented the crisis, and they point to places like Canada, where a much higher concentration of banks, but safer system ultimately.
Well, Canada didn't have a Glass-Steagall, but it has a concentrated banking system, but it also has banks which didn't get into that whole explosion of what's called shadow banking and securitized credit. I think there's a very major part of the story of what went wrong in the US and in the UK and therefore affected the rest of the world, which is, I address in one chapter, chapter 6, which is what's called the development of shadow banking and the securitized credit market and the provision of credit in packaged and complicated securities. And I think that was facilitated by the abolition of Glass-Steagall, which enabled some large commercial banks to expand trading activities in the trading of credit securities in a way which made it easier to provide credit to the real economies, but also hugely magnified the internal complexity of the financial system. I haven't talked about that this evening, but if you look at the development of the financial system in the 30 years, 50 years before the crisis, there's one phenomenon which I've talked about, which is the growth of the amount of leverage in the real economy, the leverage of households and the leverage of companies. There's another development, which I also talk about, but I haven't talked about this evening, which is for every unit of lending to the real economy, the financial system does many more units of activity with itself. It trades things backwards and forwards between itself, so that a large bank balance sheet is now dominated in a way that it wasn't by 40 years ago by a set of contracts with other banks. The majority of the balance sheet of JP Morgan or RBS or Deutsche Bank, if you look at it, you think, well, hang on, there's a bit of lending to, households, there's a little of lending to companies. What's all the rest of this? And the rest of it is lending backwards and forwards and derivatives trading with other banks. And that was facilitated by the abolition of Glass-Steagall. But there were a set of other things as well. The failure to regulate the broker-dealers, the failure to, the removal of the leverage limits on them. There were lots of other mistakes we made as well.
Let me ask you this last question before we wrap up, and then we'll go to a book signing. This has been a great conversation. So much of this, I'm just thinking of people here who have an interest aroused in these issues. They came because they're interested, but now they've been further educated, and they may be ready to march in the streets for helicopter money with the appropriate restraints or something like that.
With proper restraints.
But right, but with so much of this conversation, it feels like it's a very elite conversation where a few thousand people globally are engaged in how are we going to run the banking and monetary systems of the globe. I'm trying to think of when, in the 1890s, there was the populist movement in the U.S. where things like the monetary system and inflation
hugely important.
Became political issues. But a lot of this feels like an inside game. Do you have any thoughts for, if people are interested in this, what they should do as citizens?
That's a very interesting question. I mean, you're quite right. On the whole, these issues tend to be a technical elite, and so different from the 1890s. William Jennings Bryan, thou shalt not crucify mankind on a cross of gold, etc.
Which was basically about trying to boost the money supply.
Well, it was about boosting the money supply by using silver as well as gold, because gold was in short supply because there hadn't been major new discoveries until the South African and the Klondike discoveries suddenly sort of came to the rescue. These issues tend to be technical issues, and they do involve a certain amount of technical detail. If you go back to those debates in the 19th century, you'll find that a lot of them were very passionate, but they were also sometimes not technically correct, because people would latch on to things that they thought they could understand, like, oh, the only real money is gold. Well, the only real money is not gold, because most money is created by the banking system. But I think we need to find some way of having a wider public debate about this. We can't simply say, this is, an elite job and there's a bunch of technicians who know how to do it. Because let's be clear, those technicians didn't stop the crisis.
Well, that's the whole right. So we have to now rely on you to persuade the people who missed the boat to.
And I think we need a wider group of people able to engage in these debates and willing to put in the effort to, understand it, confident that although some of it is about technicalities, some is also about an element of common sense, which, as we discussed, wasn't always there in the pre-crisis economic theories.
Terrific conversation. Please join me in thanking Lord Adair Turner for a great conversation. And I think, should I say, Lord Turner will be available to sign books over on the side. Thanks very much for joining.
Thank you.
Good job.
Great, thanks.